We are live. Welcome to the Premium Portfolio Builder webinar. Lots to cover today. If you're on a free trial, you're getting access to our high risk, high return portfolio, now up 320% year to date, outperforming the S&P 500 14 times. Today's November 5th, 2021. If you do upgrade, you gain access to 3 other strategies. And the one really doing well this start of November and actually really well in October is the Safe Alpha portfolio, which has a huge bet on the NASDAQ with Tesla driving the entire market higher. In fact, I believe Tesla selling off will probably be the canary in the coal mine to get defensive. So we'll cover that and more. Let's just look at the strategies and what the differences are. The high risk, high return portfolio is a aggressive bet in growth assets and primarily focused on Ethereum, oil and gas, and rare earth metals. So we'll cover that strategy in detail towards the end in terms of how to build out your portfolio today. The Safe Alpha portfolio is similar to Warren Buffett's Berkshire Hathaway. Now he's big on Apple and US banks and insurance companies and some retail outfits. Our strategy is similar in that we have growth and value combined, that it's US centric. However, we're playing the entire NASDAQ with leverage. And rather than the banks, which are getting beat up today with rates falling, we're long the energy companies, which keep screaming higher and are extremely undervalued. So that portfolio is doing very well. And it's called the Safe Alpha portfolio. Now, again, once you upgrade, you can gain access to these extra portfolios. They're all going to be doing the same strategy, growth and value hedged against a crash. The way we control risk is by going after bigger or smaller markets. So while the high risk, high return strategy is betting big on a $500 billion Ethereum market, the Safe Alpha portfolio is playing the $12 trillion tech sector and the $2 trillion oil and gas sector primarily. Now, Safe Growth Pro, even though it's been lagging, is my favorite portfolio for the coming decade. A big bet that Asia and Europe will outperform the US stock market due to a weakening dollar. And this is a big trend that I see playing out. Safe Growth Pro having a good 2 months as well, up 1.8% in November. Now, if you want a combo of the Safe Alpha and the Pro, plus a little bit of the high risk, all tied up into one strategy, we call it the Bootcamp Core portfolio. It's got your tech, it's got your Bitcoin, it's got a play in solar, and it's about to jump into uranium, which we've been in and out of, which is going to be critical for nuclear power plants to get carbon emissions to these levels that the globalists want. So very good. Let's go ahead and continue. We're getting out of earnings, and so now corporations can do stock buybacks. This is a seasonality trend that's very bullish for markets. Now, with that said, we're at just blistering prices, and I'm certainly nervous. But once we look at the value of the dollar and we look at interest rates and we look at what's potentially about to happen in the House and Senate to pass a trillions of stimulus, we could very well likely have further melt up ahead. So yeah, that's the main thing to focus on right now, is that trillions in new stimulus may soon pass. So it's a red alert, buy, trade alert. And I do want you to know that if we're going to crash, I have a fantastic track record of predicting crashes and generating profits. In fact, I'm probably guilty of getting too defensive too often and sometimes missing out on some of the upside we've seen in the last 2 years, namely around the election. I thought we could have had a bigger volatility event. But with that said, we can make much more money in a crash. And in about 2 weeks, expect me to get defensive unless we get the stimulus passed. So we'll take a look at that and more as we go through the slide deck. Now, at the end of this video, after covering charts, data, and news, we will review our exact trading formulas. Now, if you're live in the webinar, you're going to see the exact trading formulas. If you're catching this on YouTube as a replay, guess what? The end is cut off. You have to call John at 505-610-1334 to upgrade your free trial. Now, a quick shout out to the live crowd. We have in live, Allie, Anita, Clifford, Clint, Ed, Eddie, Edgar, Gary, Harry, Iron Man, Rock, nickname, Jam, James Goodman, James Spalenka, Jeff Olson, Jeff Rep, Jenny, Jody, Joel, John, Julia, Kathy, Kevin, Karen, Nell, Kurt, Orlando, Lisa, Marty, Michael, Mike, Morris, Murray, My Downtown 30, Neil Hathaway, Oscar from Florida, Pat, Peter, Rick, Rob, Robert, Sean, Sung, Terry, G, Tom, Tor, Peter, Tyrone, Wendell Wells. Haven't seen you in a little bit, Wendell. Hope you're doing well. Victor Cox, my father and your dedicated support agent, who is one kick-ass support agent. We'll give him that. And Wendy. So thank you guys all for joining us live. If you're catching the replay, hope you have a great weekend. So since the September pullback, which was this big fear that the US government was going to default on its debt because it was reaching a debt ceiling, we told you that that was just a prelude to a bigger volatility event, most likely to occur towards the end of November or in December, and that the more likely outcome is that stocks, crypto, and commodities would melt up. And boy, oh boy, that was correct. And it's always funny to see people freak out on little sell-offs, sell low, and then the market rips higher, and then they come running in wanting to buy. So we're trying to teach you to do the opposite of that, buy low and sell high in this program. But here's what's critical. Even though the valuations look mind-boggling right now, we got to realize the dollar's been going up. Here's the key. Where else are you going to put your money? And we're going to evaluate that and come to some predictions on what could occur. But bottom line is, soon as the Build Back Better social stimulus plan is passed, it's currently coming in at 1.9 trillion, plus the infrastructure deal for 1.2 trillion, very likely you're going to see the markets melt up even further. And I would expect a growth to value rotation. So that'd be really good for the banks and the energy companies. So we'll cover that and more as we progress. Now, we've got rumors that they're trying to push the two budgets through the House right now today, but the moderates wanted to get evaluated by the CBO. Now, this package is 2,200 pages. I don't know about you, but I can read maybe 100 or 200 pages a day. So, none of these people are reading this whatsoever. And the CBO said it will take weeks to give it a score. And that's to try to give Congress an idea of how this is going to impact the deficit. So will that let the market have some breathing room all the way to Thanksgiving while we patiently wait to see the CBO score? Are they going to push this through to the Senate today? We will see. But that's really what's coming down the pipeline. Why we got to be patient, but realize there's a huge market risk if this thing doesn't get pushed through. Now, failure to pass the budget will result in another debt ceiling crisis. Originally, this has been signaled to hit as on December 3rd. Now, I've seen Jim Bianco come out with some data telling us that perhaps the $500 billion debt ceiling increase that McConnell gave the Democrats on a nice silver platter to buy them time may fund the government all the way through February. So that December 3rd deadline might be a little sooner. I'm going to get more in-depth analysis of this because the U.S. government running out of money and defaulting on its bonds is a huge problem. So buying into a wall of worry oftentimes results in the best return. So we need to realize that. And I just want you to know, if you do jump into our current asset allocation, it's very bullish in structure. But as we prepare for a potential problem, I will be reallocating your capital to get defensive if it looks like we need to do that. And we can make way more money on a crash in a super short period of time than we can on the slow grind of betting that the governments will spend money they don't have and inflate the value of financial assets. So I wouldn't be scared to jump in right now. Also, I want to point out failure to close a deal in November could likely cause a stock crash in December or perhaps sooner. So we're going to play this very carefully. I have a number of things to keep a close eye on. The last time we had a crash, we had 1,000% return in UVXY in 4 weeks. Here it was in March. Now we're really light on the UVXY, and I do have some interesting commentary once we start looking at charts. But we basically have the stock market up and UVXY up. And this happened a few months ago. And one of our members pointed it out. And soon enough, we actually got a sell-off pretty quickly after that. So we'll keep a look at that. Now, I want you to think about this. The market could fall 40% right now and still be above the the February pre-crash 2020 levels. Okay, so let that sink in. If we go back to the March lows, we could be looking at 2,000 to 3,000% potential returns in UVXY. So our members have been punished for hedging for 2 years now, and that day of reckoning could be coming if we don't get this bill passed. So I have a few lines in the sand to tell us we need to get concerned. And really, we want to see multiple signals fire at once. So what I would say is oil crashing and the dollar rising simultaneously is going to be the most accurate indicator that we have a problem ahead. But rather today, we have, so if we look at these lines in the sand, we've put DXY. What is that? That's the dollar against the euro in a basket of foreign currencies. Foreign countries in weak emerging markets actually raising interest rates currently. We've got the price of oil continuing to go higher, and we have DXY trading at 94.26. So 94.50 is a critical resistance level, and if it goes beyond that, it's telling you somewhere in the world there are significant dollar liquidity problems. Okay. Now, if we see oil going up and the dollar going up and the S&P 500 going up, that's telling us the weakness is coming from Europe or Asia. And that's exactly what we're going to kind of dive into today with China here. Okay, but right now it's close to that level. We've seen it touch that a few times. Big picture, I believe the stimulus is going to pass. The dollar is going to fall to 90 to 89. And that's going to be our signal to dump our oil play, which is doubled for our clients just in the last 4 weeks. Now, by the time the dollar hits 90, your NRGU position will probably double or triple from here. Okay, so that's a huge play that we're excited about. Okay, emerging markets going below 48, another line in the sand. Now, EEM is going to give us that entire area. If we want to really look at China as potentially the problem, we can look at MCHI. And then there's FXI. So these are some of the bigger ETFs for China specifically. And I've got a close eye on those. While they look weak, they're nowhere near the critical levels signifying a crash. And it's interesting that Chinese stocks have predicted many of the US crises well before they occurred. So the bottom line is either we pass this budget and emerging markets screams higher and outperforms US markets, or we fail to pass this budget. And I think we're going to see a significant pullback in stocks. So right now, we don't have the warning sign on the dollar. We don't have it in emerging markets. Now, we had a good jobs report today, 500,000 jobs. And so rates should be going up, signaling a recovery in the economy. And so today we have the TLT up 1.4%. I think it's been up almost 2% earlier today. So a lot of people are scratching their head saying this makes no sense. What is going on here? And I think what's interesting is that the labor force participation rate is not going back up. So we got all this hype about unemployment going low. The problem is it's about 5 million people who've decided to leave the labor force, and it looks like that may be permanent. So that has implications on the economy. So TLT today is at 149.18. For us to get worried that interest rates are going to become so attractive that they crash competing assets, I need to see the TLT go below the recent low of 140, where I would be a strong buyer of the TLT. But instead, we've got these rates going extremely low. So we got to ask ourselves, do we really want to loan the US government money for 20 to 30 years for an interest rate of 1.88%? While the inflation's well above 4, perhaps closer to 8%. And now we have sticky wages, we have rising rent, and we have energy costs. We have shortages in critical supplies for food. No, it's not a good bet. So the only people who are buying these bonds are either banks who need to pay interest on deposits, which there's massive amounts of money parked in banks right now, bullish for the economy, or people who think we're going to crash, have another debt ceiling crisis, and then short squeeze this massive short position in bonds into very, very low rates. So it makes no sense. And that's why we're not changing our positioning. It makes no sense to go bet on the bond market when they're about to pass several $1 trillion in spending. So unless we believe that's going to fail, I believe TLT is a horrible bet, and it won't be long until we do see the TLT go below 140, which is where I will become a buyer. Okay, now China continues to let the real estate sector crash. They're doing all sorts of interesting things, but their currency is not selling off. Their stock market has stabilized. The high yield market continues to rise, but I'm mostly interested in whether or not their stock market's going to crash or their currency is going to devalue. And so what we've seen in the USD CNY pair is that over the last year, since Biden's been in office, we've gone from 6.7 conversion rate to 6.4, meaning the Chinese currency has become more powerful and has more buying power over the last year. So there's really just nothing to get super scared about. We got Tesla maintaining this outrageous, and I'm an Elon Musk fan, but this is an outrageous valuation. It's still floating at this 1,200 price. So there's just nothing to freak out about yet. Now to summarize it, we want to see the dollar rise and oil tank to really think a deflationary spike is coming through. And while we did see oil go below 80 for a minute, and I'm sure half our members were freaking out, I know Edgar was, who's got 7 figures behind us. But look, back today at 82.50. So the Biden administration went to OPEC and said, hey, ramp up oil, man. And they said no. And so we did have them potentially threaten to release our reserves. But we're going into a 2-month weak period for oil. What are you going to do when the full economy reopens next summer and we have no oil reserve? So I think that would be foolish to do that. Now, the Baltic Dry Index has crashed. So we are starting to see some signs of some of these supply chain issues becoming resolved. But again, that's good for the economy. So at this point, no changes. My core prediction remains that we have a slow motion multi-year rotation out of growth stocks and into value. And so that's the banks and the energy companies that benefit from this. Now, while the banks have shot to new highs, the energy companies remain extremely undervalued. And meanwhile, we have hundreds of millions of people in India and China alone who are wanting to have access to transportation and greater use of energy. So the reality is, I believe the oil and gas sector is going to be the single highest returning asset that's critical to every portfolio for the next 5 years. And if we look at these cycles, 2002 to 2008, then we get the 2009 to 2015, and now we have the 2020, perhaps all the way to 2024, 2025 cycle. So get excited. The energy sector is extremely undervalued. We've printed tens of trillions of dollars globally, and now that money is going to be fighting over a limited supply of goods and services. And one good that everyone needs is oil, and that's just not changing. Now, when stimulus passes, I'd expect EDC and EFO to outperform UPRO. And last time we passed stimulus was December and January. And look, emerging markets outperformed US markets 50%, and European markets outperformed about 35%. Now, the problem was the spending didn't recover the economy, and rates went back down, and expectations of problems came right back in, and the growth sector went up, and energy went back down, and foreign stocks have underperformed. Plus, we had China go and smash and grab its own economy. But I think that paradigm is about to shift. So now in this chart, we're looking at yellow interest rates, green energy, candlestick, the NASDAQ, and remember what happened to Bitcoin in that same period. So if interest rates go up too quickly, the rate of change is really important, as well as the price tag on the interest rates. It crashes things like tech stocks. And perhaps cryptocurrencies. I'm not as convinced that they're as correlated, but we have seen that trend. Now, what protects you against interest rates rising over time? It's the energy sector. And so you can see that in this chart. That's why we have NRGU, which is XLE times 3, essentially, not exactly, but essentially, to do that job to protect us. Okay, so we're about to jump into lots of good content, but a reminder, you can call John this weekend if you're interested in joining, 505-610-1334. I see a few folks out there, and a lot more people have hopped in. So welcome. Victor says, hi, Jason and everyone. This is Victor, your support agent. Make sure you're receiving our texts and emails. Very good. And people call Victor all day, all night. He is heck of a support guy. So thank you so much, Victor. You've really helped our program grow and keep everybody on track. Edgar says, you bet I was. Yeah, he was freaking out a couple, what was it, yesterday, the day before. Edgar likes to lock in profits. So, hey, who can blame him? Harry says he's having trouble with EFO chart. No, so EFO is playing the underlying ETF EFA with 2 times leverage. So Michael says, hi, Jason's dad. Okay, great, guys. Okay, so let's jump into how we analyze the markets. A lot of people expect me to look at stocks, charts, technical analysis, and then, what do? I make you look at interest rates, yield curves, futures markets, commodities prices. And so I would argue that the bond market and tracking the government's deficit spending and tax plans are more important. So Edgar says, cash in 20K on my account this week. People need to sign up into lifetime membership now. I like that, Edgar. Yep, call Edgar for life. And Edgar actually joined our team to help bring people on board. Okay, so let's look at the yield curve. And James says, will there be a link where I can rewatch the video? Yeah, actually, James, the same link that got you in here will replay the episode once we're done. So we relink it to YouTube for you to gain access to that. Now, the paid version is private, and you'll have that in your link if you're on a trial. The one that gets remarketed on YouTube to show off just how cool we are and smart, that cuts off all the critical trading advice at the end. Okay, so let's look at the yield curve. What the heck is the yield curve? So this is on the x-axis down here. We have 1 month, 3 month, 1 year, 2 year. Now, I actually made a mistake just recently. I told you that Australia had ended yield curve control and their 2-year interest rate had doubled. Way off. It went up 500% overnight when they removed yield curve control. And you can see in the US, we've also seen the 2-year jump. So green is April, and the November print is here in blue. And so you can see from April to November, it has gone up 200%. So it went from 0.05 to 0.17. What is that, and why is it important? So this is what the market's using to figure out when the Fed's going to hike interest rates. And so the higher those short-term interest rates go up, the sooner we're going to anticipate the Fed's going to hike interest rates, and that's going to be very problematic for certain asset classes. Primarily cryptocurrencies, I would say, you got to get out of the way once they go into a rate hike cycle, because there's just a really bad, extremely bad correlation to hiking interest rates and causing stock crashes. And you can see that over here, where they, in black, they hiked up the interest rate, and then boom, you get a crash, and they have to drop the rates lower, then they start hiking it up, and then boom, you get another crash. And so we'll talk about the history of that related to each of these assets. So what do we see? Essentially, what we're seeing here is a flattening of the yield curve. So we've got those long-term interest rates starting to fall while the short-term interest rates are going up. So the market's essentially saying we've got too much inflation, we need to hike rates, but yet that's going to cause a stock crash and low growth. So not very good. Mike says, please explain why the Fed taper is bullish. Well, it's still another $500 billion coming through of the Fed tapering, but we're going to anticipate that as we ramp up debt issuance and slow down bond purchases, that interest rates will rise until they become so attractive that they essentially collapse competing markets. So that's what I would say about that. Okay, so what do we see in general with the yield curve? It's not inverted. In critical spots, we can see the 20-year has a slightly higher interest rate than the 30-year. We're going to be much more concerned if and when the middle of the curve goes inverted. That signals big problems in the economy. So nothing to freak out about that. In general, the last time we had a significant crash in tech, we had the 20-year and 30-year going up. So you can see they're going down. So this is why you see those tech stocks keep going up, because long-term interest rates are falling. But what was the interest rate that crashed everything this March? 2.4. Okay, that was the high we've had for the year. And if we get back to that level, we will begin to accumulate bonds for sure. I think the highest that the economy possibly could take, and that's a long shot, would be 3. So we'll talk about that once we get to the 40-year chart of interest rates. Okay, so now speaking about all this, right now, the prediction is that we will hike rates July to 25 basis points. That probably won't freak out the whole market. But if we go to February, the market's now pricing in probabilities of 2 rate hikes by February, and a risk of 3 to 4 rate hikes. That will certainly be problematic. And so, and again, it's rate hikes that are going to tell us to get out of the way of risky long duration assets. And again, go back to 2018, first crypto crashed. This is when we started to do quantitative tightening plus slowly do rate hikes. And what happened? Crypto crashed from 20 to what, 3? Then we had emerging markets tank. Then we had Europe tank. And then as the 10-year, I think last time I said hit 3.5, it was 3. So the 10-year note hit 3% in October, and you got the Christmas massacre. And then the U.S. market crashed. We went into to basically printing money and dropping rates back. So as soon as that happens, we'll be ready to make a lot of money on the downside. So predicting these interest rates are very important. Now, a great way to predict when interest rates could rise will be watching reverse repo. So what is reverse repo? This is when banks are looking at all the bonds they can buy in the open market and saying, you know what, we don't like these rates. It's not high enough of a pay. And we don't want the long duration ones. So we want to go to the Fed, the Federal Reserve, and borrow all these bonds they've been taking out of the market. And so that's what reverse repo does. It's very bullish for tech stocks as long as reverse repo remains elevated. The highest print we've seen is $1.6 trillion that banks are borrowing from the Federal Reserve. Why do they want these bonds? So they can pay interest on the trillions of deposits sitting on their account balance sheets. So it's been just floating in this 1.3 to 1.6 range. If we see it fall below 1 trillion and head towards 700 billion, I think you need to start to exit those tech stocks, or at least get more hedged against interest rates rising. So we'll talk about how to do that. Now in the VIX futures curve, we're interested, this is where investors are hedging using the VIX. The VIX is really just out of the money, short-term put options on the S&P 500 is the way I would think about it. So we're primarily interested when the price jumps the most month over month. And so it's this month and next month where you can see the greatest level of pricing. And so what is the problem? Well, the budget has to pass and we're about to hit another debt ceiling. So clearly that is the concern. Plus we got these supply chain issues, energy prices soaring, all sorts of problems. And now we've got this January 3rd potential OSHA problem creating labor disruptions. So we've actually seen the January now get a little bit bigger of a jump. So this is the time period to be concerned, and it's also when we could likely get some really nice returns. Okay, so here's a look at interest rates in gray, NRGU in green, and then the NASDAQ. So just note, look, here's your interest rates going down. Here's your NASDAQ screaming higher. Here's your interest rates going up. Here's your NASDAQ falling and energy screaming higher. So what do we think is going to happen next? Are interest rates going to fall? Or are we about to pass several trillion in stimulus and make interest rates rise? And so let's look at the last time we did pass aggressive spending. And so you can see, here we go, December through February, we passed 2 bills, one with Trump, one with Biden, about 3 trillion in total. Interest rates go up, NRGU doubles, actually goes up. From here, we got minus 23. At this point, we have, so 140% return. You get the tech stocks went nowhere. They actually sold off right here about 13%, and interest rates went up. So as you guys know, I believe they will pass these budgets one way or another, and that we're going to see interest rates rise, your NRGU play scream higher. So that's what we're anticipating. Now I'm ready to change course if necessary. So again, just need to be patient here. All right, Russell 2000 jumping up here. This is a index that's become the favorite for the Reddit crowd, the meme stocks. So these people keep piling into essentially bankrupt companies that have short interest. So these hedge funds have had lots of fun for decades, finding weak businesses and then collapsing them. Okay. So if you've watched that movie, Pretty Woman, okay, that's what that's all about. And then you go shut down the world, give everybody free money and connect them on the internet. And a bunch of children have figured out they can scan for these hedge funds to short stocks and short squeeze them. So the same folks who are trying to short the stocks turn around and have to buy it for huge losses. So absolutely comical. And Russell 2000 just broke up. Okay, so this has been in a trend all year, and it's telling us market's about to rip higher. You can see it jumping up here. So again, this is in line with our thinking. Okay, probably the best buy in the market today is emerging markets. We've had China smash and grabbing their own economy. They're doing some lockdowns due to the sickness currently. I've got photos of little kids getting taken away from schools in buses because a couple kids were reported with the sickness. All of this is going to go away. The government's going to stop smashing its own economy. The dollar is going to fall. The stimulus is going to pass. And I believe emerging markets is going to scream higher. So you probably think I'm crazy looking at this chart, but I do believe this is probably one of the best investments outside of the oil and gas play coming up in the next few months. Ed says, do the recent elections in which Democrats lost seats increase the probability of passing the stimulus? I think yes. I think this is definitely going to pressure them to come to terms and push it through. Good point, Ed. Exactly how I look at it and why I think they're now in a frantic to do that. Okay, now EFO is the European index. Does great with inflation and rising rates, and as you can see, it's near a high. In this chart, we're comparing Bitcoin to Ethereum. In our Bootcamp core, we're big on Bitcoin, and high risk, we're big on Ethereum. There's some important banks predicting Ethereum could go to 8,000 by the end of the year. So fascinating. I think we need the stimulus passed for that to occur. But if interest rates rise, I'm not so sure that plays out. So we got to watch those interest rates relative to the stimulus. And but yeah, Ethereum has been doing really well, and Bitcoin for both of these portfolios. Two of my favorite growth sectors out there. So we got Bitcoin at around $1 trillion market cap, and Ethereum at around $500 billion. So huge opportunity in these asset classes. Boy, gold and silver sure have been boring. Last year they did well, and our members did really well with that. I'm very surprised how weak they've been. People ask me, do you think they're going to rocket up with stimulus? No, I think they're going to rocket up if labor recovery is really weak into next year, and that there's still all this hope that there's going to be a really strong economic recovery driven by labor. So we'll just have to watch and see how this all plays out. The mandates are certainly not, I haven't seen anything about the administration's policies that are going to be super bullish on labor. So I think the day for gold and silver to shine will come probably closer to next year because it's more of a stagflation play, while we're seeing the crypto act more like the oil play. Now, if we're going to crash, I like three plays. TMF, that's really a debt ceiling crisis. So if we're going to run into a problem where we're not allowed to issue debt, and the banks need these debt products to service deposits, and stocks are going down, there's going to be and then plus you throw in a record short position in treasuries, well then TMF is going to take off. I really like that play. if Joe Manchin and Jayapal just can't come to terms. Now, I think Ed's right that the New Jersey upset and the Virginia upset is going to make it more likely they do pass the budget. If that's the case, I think TMF crashes, the dollar crashes, and UVXY probably crashes. So that's why I'm being really careful to get you guys defensive, despite how outrageous stocks look at this point. Now, if we get closer and closer to December, then we need to get more defensive. These are our three best friends. UVXY, that's out of the money put options on the SPY. EUO, that's the dollar against the euro. And then TMF, that's your 20 and 30-year treasuries leverage times 3. So those are the ones we're keeping a look at. Now in Bootcamp Core, we have a few interesting plays. We're trying to be on the cutting edge investments. So FNGU is the replacement for the NASDAQ. It gives you 2 Chinese tech giants plus 10 massive US tech giants. And with Alibaba and Baidu trading almost 50% below their highs, I really like FNGU. It's got a huge Tesla play. So anyways, FNGU is looking really good. Could go higher if rates don't rise. Okay, REMX is rare earth metals. Primarily, we're interested in lithium and cobalt, which are critical for Tesla and Apple. The supply shortage of those 2 rare earth metals is going to get worse and worse over time. So I think REMX is a brilliant long-term play. Now there's announcement after announcement of creating new nuclear power plants. Plus, we got China talking about accelerating its nuclear warhead program. So uranium's been doing very well. Now, if I zoom out, uranium has traded way higher in the past. In fact, we don't even have it here. Uranium's extremely undervalued if we're really going to have a big shift into nuclear power. So I've been waiting to pull the trigger on getting our investors back into that play. Next play we have that's not in the portfolio right now has been Copx Copper. That's been kind of a dud lately. I do expect that's about to jump with the stimulus and China starting to put credit back into its market after this big slowdown. And then we've got TAN, which has been in a recession here since March. But again, lots of push towards clean energy. So TAN is your solar panel play. The biggest dud in all of our portfolios outside of the VIX has been the MJ play. It's been a small position in Bootcamp Core. We're going to see what response it has after the stimulus passes. If it doesn't get a jump from that, then we'll probably reallocate that capital. So those are some of our bonus plays in the Bootcamp Core. Okay, here's that dollar index. When we had a massive return in October, it's because the dollar went from 94.50 to 93. Big picture, I think we're heading back towards this low right here. And that's when we'll sell our NRGU position once we get towards 90. So what's going to make it go down? Passing the stimulus. Everything's revolving around passing the stimulus. It would be suicide for the Democrats not to pass these budgets and not to pass them soon. If they go create a crisis right ahead of Christmas while they're rolling out mandates and have falling off a cliff, losing strongholds in New Jersey and Virginia, I just don't see it. So I think they're going to be very motivated to push something through. And so I don't think the dollar is going to break right now, but we got to watch those politics. Here's that Chinese currency strengthening. So really no reason to freak out about China currently. Here's your oil play, NRGU. Now it's a leverage product, so you could look at that and be like, whoa, it's a triple head and shoulder top or whatever you want to say. But keep in mind what it's really trading are 10 top US oil and gas companies. So when we look at this chart of Exxon, all of a sudden it doesn't look as overvalued, does it? In fact, it looks cheap. Its high back 2014 is 100. And I do think it will break that high in this cycle. So focus on Exxon when you're looking at chart patterns. And I think it's just getting started. The only thing that would probably give us some volatility would be a lockdown. We do see Germany starting to threaten about lockdowns. They have a huge wave developing. So US, if it were a lockdown, would probably be towards December or the very end of November. And I'm not sure there's a political willpower to do lockdowns with all the problems occurring. And it's blue states that are more willing to lock down than red states, but the blue states are having lots of problems in politics. So I think the likelihood of a lockdown is much lower now that we've seen Virginia and New Jersey flip. So unless if you put a scared animal into a corner, they can do some unexpected things to defend itself. So if they really can't pass the budget, I would not be surprised if we get a lockdown. But with that said, they should be much more pressured. Okay, so this is a chart that's problematic. We got rates going lower, oil jumping higher. Either the rates go up or oil goes down. This will not remain. These two are highly, highly correlated, and they've been in a relatively big disagreement since June. Or since May, excuse me. So you can see this pattern. Now, which one has artificial manipulation to suppress it? The bond market. Okay, so we've got the government goes and sends out trillions of dollars that are sitting in banks. The banks have to pay interest, so they're gobbling up the debt products. And then you got the Federal Reserve competing with the banks, buying these bonds. Okay, so of course the rates are going to look lower than they would naturally. Okay, meanwhile, we got oil going up, and it makes the governments look bad with oil going up. So they want to try to pressure the price of oil lower with whatever power they have. So unless we lock down and fail to do the stimulus, I expect rates go higher, and so does oil. We do have several notable banks predicting $90 oil by the end of the year. So currently we got Brent oil at 82. Now, a lot of these banks are predicting we go towards 120 by next summer. So we're going to be likely holding on to NRG. Maybe we manage risk and position size, but it's looking very good for that play. Here's your copper futures. So Dr. Copper, we'll take a look at that in a minute. But copper's at record. It looks like everything in the world is going to reprice higher, and then maybe those prices stabilize, and hopefully we don't go into a long-term inflationary cycle. So yeah, we just got to get used to everything being priced significantly higher. As far as what we're seeing in this chart, just get ready for China to turn on the printing presses and expand their economy, and that copper is going to go right back up. So strengthen the copper, stabilizing at this higher level currently. Now we got lumber futures and gas futures. We have seen some weakness here. Let me zoom out a little bit. So what we're seeing is these inflationary spikes are hitting one asset at a time, or one commodity at a time. So first we had the lumber go parabolic, then crash, and now it's bidding back up. That's the candlestick. Next, we had natural gas go just to extreme highs. This is apparently creating problems in the food supply chain to the point where farmers aren't going to be able to plant as much food next year. So now they're starting to predict famine globally next year. And this is starting to cause people to switch from natural gas to oil. So during a normally weak 2 months for oil, it might be actually stronger. So again, we're really not seeing weakness anywhere to believe we're in a deflationary problem. The Baltic Dry Index measures the cost of shipping, primarily of commodities. And so there's been a big crash in that. That cost has dropped nearly 50%. So that's signaling some of the congestion is resolving. So that's a good thing. I'd expect this to stabilize and trade at a higher price, just like we're seeing with everything else. So keeping a close eye on it. This is probably the most bearish chart we have right now, that and the dollar. Okay, here's those bond rates going down today. with the supposedly great jobs data. I believe they're more interested in the labor force participation rate not rising, signaling that there's 5 million people who don't want to go back to work for whatever reason. Now, if we zoom out, you need to realize the only way the US government can remain growing its deficit and making good on its promises is in the long run driving these rates lower. So I do believe in our lifetime we will see these rates go towards zero, just like we saw in Japan and Europe. It's just a very short-term period. And by short-term, I'm saying a year or two, 3 at the most, that we're going to see these rates slowly rise until they get too attractive. I do not believe you will break the 2018 high of a 3.3 on the 30-year, and on the 10-year, we can see the high was 3.1. Okay, and that's when you got a crash into winter. So my belief is we should buy bonds aggressively as soon as we break past 2.4, and it will be impossible to predict the exact top, but we will hold drawdown with a big smile, realizing that the global economy cannot support bonds paying these levels of interest rates, and that it will collapse everything around it like a black hole sucking in everything. So we're going to be buying bonds as soon as we break 2.4. And there's a small chance we'll buy bonds if we think there's going to be a debt ceiling crisis coming up, because that could certainly drive these rates lower for a quick hit. Okay, now gold to copper ratio. This is predictive of interest rates. They call it Dr. Copper, and they're comparing the price of copper, which is used to build stuff, to gold, which is something you buy when you're worried about stagflation versus reflation. And so I just want you to see a feeling for, if we do recover the economy, just how high this ratio could go, and why you probably shouldn't get too bullish on gold and silver unless we really have a problem with the economy. If it is recovering, interest rates will go up, and you're going to make a lot more money in oil and copper plays compared to gold and silver. And so this could be just getting started here when we look at the period that we're interested in, 2002 to 2006. Okay, here's the main bond markets we're interested in. TLT funds the government, LQD funds your Apple and Microsoft, JNK funds all your Russell 2000 junk companies. And so if these are falling, interest rates are going up, access to capital's becoming more expensive, problems. They're not, they're going up. So free money for everybody who wants it. Nothing to freak out about there. Okay, this is where we track the issuance of debt. Not worried about this when we've got reverse repo at 1.3. So bring it on, Janet. Print some bonds, put them in the market. Good for everything we're betting on currently. Now the problem is she's going to hit her new debt ceiling soon, and then the government's going to run out of money, and we're going to have another crisis unless they can pass the reconciliation bill, which is being labeled the Build Back Better bill. All right, here's your big print today, 531,000 jobs. That's not enough, obviously, to freak out the rates markets. If you start to get some 900 to 1 million prints, probably going to get some rates rising. We definitely had some rates rising when we got 785,000 jobs. But then what happened? We had poor labor the next few months, and rates began to fall. So with mandates coming through and potential new wave of the sickness, I'm not thinking we're going to have really hot labor prints. And then plus OSHA coming through. So I don't know. We'll just have to watch this closely. I'm not too bullish on labor recovering, but we just got to watch it every month and react to that as it comes through. Core inflation rate was flat month over month. I believe this will start to rise next month. This is going to be due to wages rising, rent rising, and energy costs rising. which again should signal that we need to hike rates, but I believe the Fed is going to be waiting for labor markets to recover to hike rates. Okay, bank credit is growing. That's bullish. That's how we're positioned. Consumer credit is continuing to grow. And as interest rates go up, banks are more likely to want to lend. Retail sales continue to grow, so no signs of a weak consumer. We can see consumer has slowed down, but it's still at record highs. So really funny to look at this chart. Record consumer spending when we shut everything down, destroyed 10 million, 18 million jobs. But what do? They spent 3 trillion a year in deficit spending, handed it out to everybody. Okay, lots of job openings. Producer prices continue to have more and more expensive input costs. We're starting to see this hit companies like Amazon. Their profitability collapsed. Only sector they really had profits on was their cloud computing. So good thing they had that. We'll see if that pressure relieves itself a bit. We had Apple is having to slow down iPad production to help out with iPhone production because of chip shortages. We're seeing some problems in profit margins starting to occur, especially if the wages start to rise here. Initial jobless claims came down a little bit, so heading in the right direction. Wages starting to consistently rising. Now, this is why I believe the bond market had a bid. Now, we do know there's a big short position, like a record. So why did a decent jobs report make bonds push rates lower? I believe it's because of this. They're hoping that, well, the bears who think rates are going to rise want to see labor force participation going up, and that's just not happening yet. And so if we do zoom out, we can see the level we had in 2020 significantly higher. So that's about a difference of 5 million jobs, 61.5 compared to 63. If we really zoom out, we can see from 2016 to 2020, we did rises from 62 to 63. Outside of that, we've had jobs collapsing. And I'm going to tell you, the stock and bond market, the way it's leveraged, cannot handle everybody getting a job. Okay, so the last time we had a period of strong labor growth at the participation rate, stocks and bonds collapsed for a decade. Okay, and that's from this in the 70s. So very fun. You wouldn't think that, but that's just the way it is. We could analyze that more if it actually starts to happen. But it looks like a lot of people just have no interest in rejoining the market. Trade deficit, wow, holy smokes, huge drop. That's a new print. So balance of trade, highly negative. That's why we believe stimulus will benefit foreign continents the most, because it's going to drive this trend worse and worse and worse. And really the main reason why labor is not going to recover, because we're not making our own products. Personal income is not collapsing yet, so that's not a problem to be concerned about. We got Apple doing fine. Now we're looking at specific stocks that could signal a problem. I believe Tesla tanking will be the canary in the coal mine to get worried. So watching that, it's now the top ticker on my entire watch list, that and Exxon. So you got your ultimate growth stock, Tesla, and you got your ultimate value stock, Exxon. The two together work well. ARK funds, super over leveraged and long duration assets. If interest rates go up, this puppy is going to tank. She sold her Tesla too early. So this is an extremely oversubscribed ETF that could potentially create systemic risk if everyone were to freak out and sell it. So that's another one on my radar. Okay, Tencent is a massive software company out of China I track. stabilized, signaling the smash and grab in China could be over. And then Alibaba's the other one. Okay, it's stabilized, not falling off the cliff anymore. So stabilized on that front. Now in our EFA play for Pro, Samsung needs to stop crashing here. So that's pretty significant pullback. Seems to be stabilizing from its all-time high here. It's down 35%. So I would like to see Samsung stabilize here. And then we got Toyota. So these are the individual names I'm watching to try to find canaries in the coal mine. Okay, China's PMI coming back up, signaling that they're done with this cleanup of their economy. European PMI still positive territory, although falling. A lot of protests all over Europe due to mandates, and we've got threats of new lockdowns in Germany so far, and I think maybe Ireland, Scotland, having some new sicknesses, fearing lockdowns. China imports at a new high. So just China's kicking butt, even though their stock market isn't saying that. By the dip, they're doing well. And now again, China's inflation rate looks low because their currency has strengthened. All right, let's look at these central bank balance sheets. So new high on the balance sheet and a new high on stocks. What do you know? $8.57 trillion has been used by the central bank to suppress US government bond interest rates and allow the government to spend more money than it could get away with. So it's a lot of people think it's the central bank balance sheet that's making stocks go up. I would argue that this is enabling the government to spend money it couldn't normally, and that's what's really inflating financial assets. So that's why the stimulus going through is so critical right now. All right, Europe's balance sheet jumped up. Bank of England surprised and didn't hike rates. So market like that as well. Now Japan has slowed down their printing. They have not been growing their balance sheet for some time now. Okay, so that's the key data I watch. So we got the House getting ready to try to vote on both bills, but will it pass the Senate? And it looks like not without the rating on what it will do to the deficit. So right now, I don't think we have a deal, and it's going to be problematic and potentially drag. Now they're saying we won't get that rating until Thanksgiving. So everybody's going to be on needles until we know if this budget's going to pass. It's very cloudy as to whether or not it will pass. I don't have a good idea. I don't think it's going to pass next week. So we'll have to pay close attention to this. I have a lot of data. I would follow Chad Pergram if you want really, really good. He does these hitchhiker guides on Twitter that are very interesting. Or you can follow my Twitter handle, which is @GenerateSIncome, if you want to really get a lot of good info. So I'll post that in the chat box for everyone. Now I don't tweet my own stuff. I just retweet interesting things. Okay, so a lot of people are looking at the PE multiples and saying, wow, this is very overvalued. This fellow says, well, look, after recessions in the early recovery, those PE multiples look high, but then earnings come up and they come down. And so he's saying, he's big on, this guy loves his banks and believes we're about to have a strong recovery led by banks, which would mean your energy will likely outperform that, which I agree with if we keep the money flowing through the government. Shortage of nitrogen fertilizer due to soaring natural gas prices is threatening to reduce global crop yields next year. Have some pretty bad problems in poorer countries. Alexandria Ocasio-Cortez says, can't wait for the full-on slam news cycle about how conservative Democrats held up Biden's bill this week. or the week of the elections, for sudden demands for CBO scores and tax cuts for the rich. So we're talking about the SALT reduction. Won't hold my breath for it though, and that's exactly what's going to hold it up, the CBO score. David Hunter's been saying we're going to have a pullback for a week or two, and we keep melting up. And again, I believe we will get a pullback if they fail to pass the stimulus. If they pass the stimulus, get ready for just eye-dropping melt up ahead. Javier Blas is commenting on whether or not we might release some of the oil reserves, the strategic petroleum reserve. That could help get the cost of oil down, but would that freak me out of EnergyU? No, because that means we're going to have a bigger problem by next year, and even a bigger melt up in price of oil. So I don't think they're going to do that. If they did do that, your growth position is going to go up. Your tech stocks go up because interest rates come down with cost of oil easing. So we're hedged against that. Lisa Abramowitz says, good luck trying to come up with the fundamental narrative for bond yields right now. The October jobs report was better than expected, with the labor market showing real signs of momentum and yields fall. So why? Well, we know there's massive short position and the labor force participation rate is stuck. So that's probably why. Now, productivity has fallen in this chart, while wage costs and prices of goods and services have gone up. So that's not good for earnings. So again, we'll see how this plays out. Florida governor says, get ready. If you've had your double dose of medicine, pretty soon you will be marked as not having taken the medicine and need your third dose. And that's going to go on indefinitely. Unfortunately, that does seem to be the case. What impact does that have on the economy? I believe it's going to slow the economy and keep labor weak, which is good for crypto positions. Peter Bodart says, when you refer to a melt up, would that be more in tech growth? I would expect the value to outperform, and that only if interest rates spiral out of control that you get the sell off in tech. Meanwhile, the call option is skyrocketing higher. So what happens when someone buys a call option? So Tesla specifically has some mysterious, massive players behind it. Maybe it's central banks, maybe it's big hedge funds. They're buying weekly out of the money call options in the hundreds of millions of dollars. The people selling those have to buy Tesla to hedge against being short with a short call by selling the call option. And so this is what's been, that's why Tesla loves to get all these people trying to short Tesla while someone comes in with massive call options. You get dealers buying Tesla to hedge against their risk, plus all these people trying to short it go negative, and the only way to get out of the short is buying the stock itself. So the reason for Tesla going up has nothing to do with anything about the profitability of the company whatsoever. It's completely based on this, the massive call options. And this has been going on a long time. So yeah, as soon as the rug gets pulled, I would expect a 50% correction in Tesla. Tom Cotton says House Democrats want to vote tonight on a 2,000-page bill that spends trillions, grants amnesty, and rewrites the tax code. There have been 0 hearings. The bill is still changing. I think this came out 2 days ago, and they keep changing it. So no one's read this. No one has read this at all. Chad Pergram's got a lot of stuff. I mean, he's posting constantly. So if you want to really be up to date on the spinning, follow him. Bottom line is there's no deal anytime soon. But it's not killed either. So that's why we're remaining how we are. The OSHA got pushed to January in terms of coming in on employers with over 100. Now they're talking about going after smaller companies next. Boy, oh boy. As far as strength in labor, pretty much across the board, except for the government. So pretty universal recovery in labor. So I like that print. If you give me prints like that every month and start to push towards 700,000, we're going to have to change our look at the markets. So we'll keep a close eye on that. China's climate goals hinge on a 440 billion nuclear build out, France to build small nuclear reactors. Japan's carbon goal is based on restarting 30 nuclear reactors. So yeah, URA makes a lot of sense right now. Now, Karen's pointing out that there's a new antiviral therapeutic that's come out with 95% efficiency. I haven't had time to look at the case trials on that one. But we got Moderna crashed 50% from its high. So Karen says, will this new pill help recover the economy faster? Yeah, I've seen those headlines. One of the folks I like to follow who's highly critical of all this likes the data so far. I just don't have enough info on it yet to make a judgment on that. CBO is probably not going to come in until Thanksgiving. So is the market going to be patient all the way up to the last second? Probably, unless there's somewhere else to put your money that's more attractive. So if rates are going lower, that's not attractive. The dollar's at a critical level and will crash if we pass stimulus. That's not attractive. So I don't see where else you put your money right now. That's why we're not changing our positioning. German state leaders said on Friday that hospitals could soon become swamped by sick patients, and a new lockdown might be needed unless urgent action is taken to reverse. So is this coming? We will see. I'm not sure. I think the Virginia governor election killed the probability of lockdowns unless it's desperation. So let's just carefully watch Joe Manchin and Jaya Paul work out a deal here. Julian Bridgen is saying we're going to hit the low unemployment target by January if we keep 500,000 jobs coming in. Sure, but our labor force participation rate is way low. It's 5 million jobs short. So so that means wages are going to start to skyrocket if the labor market gets tight, and that's going to start squeezing on profit margins, especially for your growth stocks. Okay, and that's what Daniel D. Martino Booth is pointing out. 531,000 headline beats 450,000, way more than September's 194, big revision. So September got revised up by 41,000 jobs. Unemployment rate goes down to 20 basis points from 4.8 to 4.6. Labor force participation rate unchanged at 61.6. Important. Okay, that's telling us there's no one else to hire pretty soon, which means wages are going to start wrecking earnings and create this inflationary pressure. Now this is a neat chart from a popular bear, what's his name, Savan Henrik. And so we can see in blue the Wilshire. I'm not sure why he likes that market in particular. But what he's showing you is that the GDP total tends to be the valuation of the Wilshire index over time. And at 22 trillion GDP, we've got this Wilshire index at 48. So he's obviously predicting a crash at some point. And I believe inevitably it will occur. And we're going to make a lot of money when it happens. So just don't get all worried about it. The fact that the Chinese property market is more than 10% down this week without any media coverage at all in the West goes to show that no one knows what is going on in China. It is frankly pretty scary. Now, all of our journalists have been kicked out of China, so we definitely don't know. So that's why I watch the currency. The currency is a closed account, so they control that exchange rate. Their bond yields on junk bonds are spiraling out of control. Actually looking at investing in that for our pro strategy. Ticker I'm looking at is KHYB. And again, I'd want to see stimulus coming in, but not pulling the trigger on that. But yeah, their key stocks, Tencent and Alibaba, stabilizing, currencies remaining flat. Those are really the only two things that we can really gauge. And then we can look at bigger indexes, MCHI, FXI, both stabilized, or the broader Asia area with EEM stabilized. So at this point, not freaking out about that. Here's some companies down a lot. So if you're long Tesla, just be worried. Zillow down 67%, Robinhood down 57%. I'm not sure what Fiverr is. Pinterest down 50%. Peloton was hiding a inventory buildup, massive inventory buildup, 48%. Lightspeed 48%. Wix 47%. Zoom 44%. Moderna 43%. So watch Tesla like a hawk. That's from their highs to current price. Probably from March. That's when most of these tech stocks got wrecked by interest rates. Post the Raven thinks that, here's what he says. When the valuation delta between Tesla, who in my opinion has crappy autonomous technology, and General Motors, who has actual autonomous technology, see below, closes, I expect both companies to meet at a valuation closer to 150 billion. That's a 2 times for General Motors and an 85% crash for Tesla. So I'm not saying I agree with him, but here he's got his General Motors car doing some auto driving here. This fellow says, I sold my house to Zillow last week for $550,000, 25% above market. And they just called to ask if I wanted to buy it back. I offered $350,000 and they accepted it on the spot. So Zillow went and bought, I think, a couple $1 billion worth of property and then started losing hundreds of millions and dumped it all, and they're firing 25% of their staff. I don't follow the details of all these companies individually unless they're top market cap companies that could affect systemic risk. But Jeff Winiger, tough to watch others make piles of money speculating on garbage, isn't it? They don't realize the market's winners don't win forever. If they appreciated that, they wouldn't own garbage, would they? The class of 2000 learned this lesson. So he's comparing the dot-com bubble to where we're at today, showing growth beating value. Now, when did value outperform growth? Okay, coming out of the 70s. And in the long run, value has greatly outperformed growth. It's really just the last 2 decades where we've been in an interest rates going lower and lower and lower regime that we've seen growth dominate by many multiples. And unfortunately, I do think after a short-term outperformance of value, that the structural demographics and the big picture will drive rates even further, and your tech giants are going to dominate once again. But we need to see that price of oil get outrageous and create a problem first. So Ottavio Tavi Costa says, you don't fight inflation with double-digit twin deficits to GDP, rates at 0%, and 400 billion of QE. and more importantly, restricting commodity companies from exploring, developing, and producing natural resources. So he's pissed off. His gold and silver and gold miners haven't been playing out. And again, I think you need to have weak labor with the government spending going full throttle and rates remaining below inflation to get that big squeeze in gold and silver. So let's see some prints. You can show me prints below half a million. I'll get more bullish in that sector, but you start to see that head towards 750,000 jobs, then perhaps your copper and oil is going to dominate. This guy is very fascinating to listen to. I like his analysis. Varad Markets. I don't know who exactly he is, but I've been following him. FOMC take inflation versus employment scenarios. Let's just pull up his table. This is what does a great job. Okay, so here's what he's got. Collapse in jobs creation. We only add 100 to 300,000 jobs. And what does he expect? Yields collapse, economy faltering, Fed can be patient. That'd be the ease off transitory indeed. Base case, yields ease off a bit, then consolidate, and inflation remains concern. Okay, now his base case is we're going to get 500,000 jobs. This will not piss off the interest rates, and the Fed will have to slowly hike rates gently into the next year, July, which is what's being anticipated. Stellar recovery, 750 to 1 million jobs added, and he believes this could spike yields, and that's what could crash markets. So a lot more obviously in the table with multiple scenarios, but I like that and agree. And so those jobs coming back online are going to be important for predicting rates and where to invest our money. He's got a huge thread on that. Now, this is important. The way they worded this was interesting. So I'll just read it and then we can talk about it. The December FOMC meeting will be important for markets. The tapering announcement was generally as expected, but at the same time a little different. Yes, the FOMC announced the Fed will purchase 15 billion fewer securities beginning in November, as expected. However, here's the interesting part. The Fed pre-announced a second tapering of 15 billion in December. That means that beginning in January, tapering is still a wild card. We will expect another cutback of 15 billion in January. However, it's not guaranteed. Theoretically, they could stop tapering in January, or they could increase the pace of tapering. Overall, it looks like the December FOMC meeting will be important for markets. And then, of course, that's going to be the inflation and probably more importantly, the labor recovery that's going to dictate that. Plunge protection team says 70% of the US GDP is the consumer. Macro bears saying we are in a recession with a micro dip in the curve. I'll take the other side to that all day long. Credit cycles don't end at the loosest lending standards in a quarter century. Is this time different? Doubt it. Reflation, XLF, tightening credit. And we're seeing the credit cards expanding, the bank credits expanding in the last two charts I just showed you. HOZ, I don't know who he is, says this market can crash 40% and still be at the February 2020 levels. Let that sink in. So that VIX is attractive if we get the perfect black swan. German news agency compiles a list of 75 European athletes who have died suddenly in the past 5 months. It's taking the medicine. It's really interesting. It seems young males are having big problems with this medicine, specifically with their heart. Peloton inventory went up 250%. So supply, too much supply, not enough demand for Peloton as the world's reopening. They got ahead of themselves. Tracy, Chai Girl on Twitter, she's pretty well respected for analysis of commodities. Crude oil is hitting a period of seasonal weakness, usually November to mid-December. I realize this year may be totally different. That's because those natural gas prices going parabolic and the gradual reopening, although the lockdown's the wild card we're going to predict. So she shows that seasonality of weakness here. The tech stocks tend to dominate in November, December. Okay, so we'll see if that plays off. So far, we're seeing that, obviously, right now. Here's an interesting chart. UK is publishing really good data. If you're over the age of 30, you're having a higher rate of infection compared to the, if you've had the medicine compared to not. So very, very interesting. That tells me there's a risk of hospitals becoming overwhelmed this winter in the US. So we have to keep that in our calculations here. OPEC is not going to ramp up production. Neither are US oil and gas companies. So pressure for prices to at least remain stable and then rush higher into next year are intact. Mr. Whale says Elon Musk has made more money in the last 9 months than Warren Buffett has made in his entire life. He's now worth over 3 Warren Buffetts. Okay, usually when things don't make sense, it does not happen for long. So I don't think Tesla's going to be able to keep this market valuation in the short term. Now, 10 years from now, sure. 5 years from now, sure. But for the next 12 months, probably not. Daniel D. Martino Booth says productivity is down 3.2, unit labor cost is up 7.4, wrong direction on both, compressing profit margins. Bill Ackman, central bankers have not considered how inflationary ESG initiatives are. ESG is not transitory, but rather persistent and growing. Stakeholder capitalism will drive much needed increases in wages, but also higher energy costs, among other inflationary factors. And he went and did some special presentation urging the Fed to hike interest rates and stop printing money. All right, we'll end with a funny joke from Savon Henrik. Breaking the first Tesla bike. Well done, Elon Musk. Got this funny guy. I don't know what country's riding his bike with no hands. I actually had one other interesting tweet I didn't see from Bill Gates. Let me see if I can find that little video clip. Anyways, Bill Gates is now warning us that we're going to have a worse pandemic. It's going to be a smallpox bioweapon released in 10 airports, maybe. Looks like that got lost somehow in my feed. So, okay. All right. Very good. So let's go ahead. Now we're about to go into the breakdown of asset allocation. But real quick, we got to do our little closer. So if you're getting this on YouTube and not in the email or the live webinar, this is where your video ends if you're not a paid member. So give John a call at 505-610-1334 to upgrade and gain access to all our programs. Just a little teaser of what you get when you do join is this membership area with a position calculator where you can go in to, let's say, so Safe Alpha is the one that's been dominating this month. You tell it, all right, I want to invest 100 grand. Then you hit calculate and it's going to tell you exactly what to buy. Now, all of our members follow the same ratio of shares. So we all get the exact same returns. Most of the time we're doing well. There's periods where we're doing bad. So we all get the exact same experience at all points in time. And that's what makes this product so popular. And there's really nothing like it out there. We have 4 strategies. You get your Safe Growth Pro. That's the Ray Dalio Global Strategy. We give you the Safe Alpha. That's similar to Berkshire Hathaway. You get your Bootcamp high risk, that's a big bet on Ethereum, and then you get your Bootcamp core, playing clean energy and Bitcoin. Okay, so very good. We're about to jump into all the details of that. And again, call John, don't miss out. If we're going to crash, I'm going to make you a ton of money, 505-610-1334. Again, I think the base case is we're going to melt up, and you should be building out our bullish setups right now. And that we're going to climb a wall of worry. Rates are too low, the dollar's too high, there's nowhere else to put your money. The Fed's going to keep printing money, and the government's about to pass trillions in stimulus. So unless that all goes wrong, we want to remain intact. Okay, I'm going to end the marketing video and jump into asset allocation.